Good afternoon. Welcome to Market Wrap number 156. Stuart Williamson here at the helm. This is our weekly update of what may or may not be happening in the UK residential property world. Last week we discussed the 606,000 people who moved to the UK in 2022 as immigrants, illegal ones, not illegal. This week we look at more of a global approach and see what is happening worldwide using the Economist magazine as a source. Plus hidden gems, where are the next 3 regional markets to put your money into? So last year, 1.2 million people moved to the UK, almost certainly the most ever in a year of net migration, according to Economist. Australia is twice the rate of what it was before COVID-19. Spain's equivalent figure recently hit an all-time high. Nearly 1.4 million people are expected to move to America this year, a third of more than before the pandemic, and in 2022, net migration to Canada was more than double the previous record. In Germany, it was even higher, with migration higher than the crisis of 2015. So the world's in the middle of an immigration boom, with its foreign-born population rising faster than at any point in history. Now, what does this mean for the global economy? Specifically, what does it mean for the housing world? Not long ago, if you remember, it seemed that many of the wealthy countries had turned decisively against mass migration. In the UK, Brexit. In America, Donald Trump. That was basically where people were turning against the migrant transfers. Politicians from Australia to Hungary promised to crack down on migration. Then COVID closed borders. Migration actually came to a standstill, and people decided to actually go home. Between 2019 and 2021, the population of Kuwait and Singapore, countries that typically receive lots of migrants, fell by 4%. The number of immigrants from Australia exceeded the number of immigrants into Australia for the first time since the 1940s. The surge of migration had brought back a sense of normality to some places. Singapore's foreign workforce recently returned to its pre-pandemic levels. In other places, it feels like a drastic change. Let's take a couple of examples. We're going to consider Newfoundland and Labrador. Not well-known places, but interesting nonetheless. Canada's second smallest province by population, normally home to people of Irish Catholic descent with accents to match. Net migration to the provinces there is running at more than 20 times the pre-pandemic levels. Now St. John's apparently feels more like Toronto every time you visit. Heart's Delight, a small rural settlement, great name, isn't it? You'll love it, has a Ukrainian bakery, Bosch. The provincial government is setting up an office in Bangalore to help recruit nurses. The new arrivals in Newfoundland are a microcosm of those elsewhere in the rich world. Many hundreds of Ukrainians have arrived on the island, a tiny share of the millions who've left the country since the Russians invaded. Indians and Nigerians also appear to be on the move in large numbers. Many speak English, and many already have family connections in richer countries, in particular Britain and Canada. Some of the surge in migration is because people are making up for the lost time many migrants acquired visas actually prior to 2020, 2021, are now only moving. But it puts the richest foreign-born immigrants at over 100 million, the richest countries. It's now above the previous post-crisis trend, suggesting something else may be going on, not just migration. The nature of the post-pandemic economy is a big part of the explanation, apparently. Unemployment in the rich countries is at 4.8% and has not been so low for decades. Bosses are desperate for staff, with vacancies near an all-time high. People from abroad, therefore, have good reason to travel. Currency movements also may be another factor, in that the British pound buys more than 100 rupees compared to just 90 in 2019. Since the beginning of 2021, the average emerging market currency has depreciated by about 4% against the dollar. This enables migrants to send more money home than before. Many governments are also trying to attract more people. Canada has a target of welcoming 1.5 million EU residents in 23 to 25. Germany and India recently signed an agreement to allow more Indians to work and study in Germany. Australia is increasing the time period that students can work for after graduating from 2 years to 4 years. And Britain has welcomed Hong Kongers fleeing the Chinese oppression. Well over 100,000 have arrived so far, mostly living in South London, apparently. Many countries have made it easy for Ukrainians to enter. Even those countries hitherto hostile to migration, including Japan and South Korea, they're both now looking more favourably on outsiders as they seek to counteract the impact of ageing populations. Economists welcome lots of migrants as they tend to benefit economies in the long run. Just look at America. Immigrants bring new ideas with them. In America, immigrants are about 80% more likely than natives to found a firm, according to a recent paper by Pierre Allais of the Massachusetts Institute of Technology. Pierre Allais, also an immigrant. Research suggests that migrants helped in building trading and investment links between their home country and the receiving one. Also, a slug of young workers also helps generate more tax revenue. Some economists hope that the wave of migration would have more immediate benefits, however, in that high immigration is helpful to the Federal Reserve as it tries to cool down the labour market and slow down inflation. Those arguments may be a little too optimistic. Having more people does increase the supply of labour, which above all else reduces wage growth, but the effect is pretty small. In Canada, for instance, pay is still rising by about 5% year on year. Migrants also lift the demand for goods and services, which can cause inflation. In Britain, new arrivals appear to be pushing up rents in London, which are already constrained the supply of housing there. A similar effect is in Australia, where estimates by Goldman Sachs, the bank, imply that Australia's current annualised net migration rate of 500,000 is raising rents around the country by 5% per year and leading to an overall higher CPI. Demand from migrants may also explain why, despite higher mortgage rates, house prices in the UK have not fallen by much. Over the next year or so, migration may come down a little bit. The post-pandemic catch-up will end. Rich world labour markets are slowly starting to loosen. In the very long term, it could be different. It could well be different. But the global slowdown in fertility rates means there may be a shortage of migrants to go forward. Yet there is reason to believe that the high levels of new arrivals will remain in place for some time. More welcoming government policy is one factor, as migration today begets migration tomorrow. As new arrivals bring over children and partners, before long the rich world's anti-immigration terms of 2010 will seem like an aberration. And it's a good thing. Long may it continue. Now quickly, let's look at pockets of regional growth in the UK, whereas research showing are still good places to buy. Let's look at Sheffield first. Once renowned as a centre of steel making, Sheffield has become a metropolis of opportunities with ever-increasing population of young professionals and businesses. This growth has led to a rising economy and a forward-trending location for new real estate investors and homeowners. It is one of the greenest cities in Europe, with over 2 million trees joining together city parks, and just outside you've got the nearby Peak District. The growing economy that has expanded by 98% since 2000 and reached a value of over 16.4 billion in 2022. Projections indicate that the city's economy will continue to thrive, and expected growth of 63% to reach 26.8 billion by 2035. Average GDP growth per capita shows significant increases of 87% since 2000 and is forecasted to reach £43,000 by 2035. House prices increased in Sheffield by an average of 16.7% since the early 2000s. The underlying supply and demand imbalances are expected to remain in place in the years to come. It's expected they will continue rising at over 11% by 2027. This will offer great and excellent value for investors, as prices on average are 9.4% lower in cities in Sheffield as around the surrounding cities in Leeds, Birmingham, Manchester. Now, second top tip, you may not think it's a top tip, you've already appreciated this town, Edinburgh. I mean, it's celebrated as by UNESCO as one of the World Heritage Cities. It's got distinctive, buildings in the sandstone, tall, high architecture. But amazingly, average GDP has grown by 37% since 2000. It's at 21.4 billion. Average GDP per capita has risen 17% since 2000 and is expected to rise by 75%, reaching £96,000 by 2035. That is amazing. Due to a combination of substantial economic growth and structurally undersupplied housing market, house prices have increased by 60% over the last 12 years compared to the UK average of 53%. Analysts expect to see the highest price growth of all the UK cities. This trend is expected to achieve unless a stable future house building policy is agreed. Basically, they expect house prices to grow by 17.6% over the next 4 years because there is not enough property being built in Edinburgh. Same story in Manchester, which I'll get to in just a moment. Manchester is the second most populous area in England after London. Since the Industrial Revolution, it's played a major part in driving the UK economy. And like them or hate them, the Mancs are a hard-working group. In terms of construction activity, it's expected that 5,544 housing units will be completed per year between 2020 and 2031. This is below the average house price requirement of 6,500, so that's 1,000 less. Taking in the current backlog and future housing requirements into account, the undersupply of at least 82,000 housing units could exist by 2031. Persistent undersupply has meant that the average house price in Manchester has increased 99% in 10 years to March 23, and is forecast to see some of the highest levels of price growth of any UK city at 19.3% over the next 5 years. Looking at rents, Manchester's rent prices have increased by 20% over the last 5 years, compared to the broader Northwest region of 11%. Between 2023 and 2027, rents in Manchester are expected to go up by a further 21%, surpassing the national average, which should go up by 15% over the same period. So that's some quite amazing stuff. Regionally, some great places to buy. Overall, if you look at the bigger fundamental picture, house prices are not going to fall in the UK at any time soon. We're going to see the levelling up agenda striking and those locations going up. That's where you should be buying. Hope you enjoyed it. Hope you liked it. Quite technical. Do refer us to other people. Do like, subscribe. Take it easy. Thank you very much. Bye-bye.